In this episode, I discuss how important it is to understand how infinite banking affects your income statement and your balance sheet, and how you can really mess things up in your mind if you misclassify policy transactions. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everybody, welcome back to the show. I'm doing something new today, by the way. I'm actually going to be recording my screen as we go through this episode. So if you're listening on Apple Podcast or Spotify or something like that, I think you'll be able to get everything you need to get out of this episode without following along. But just note that we're also posting this to YouTube with a live feed, and you can, watch as I drop some diagrams. So the basis of this episode is going to be built upon mainly a truth that I believe, which is infinite banking. It clicks in your mind when you start to fully understand how different policy transactions affect your overall financial well-being. On the flip side, it can remain confusing and scary even, like very concerning, if you are misclassifying policy transactions. And so what we mean by that, when I say misclassify policy transactions, I'm talking about like premium payments, loan repayments, and policy loans coming to you if you are classifying them incorrectly. In other words, if you are putting certain transactions on your income statement in your mind, but they actually belong on your balance sheet, then it's going to be confusing. So what I'm going to do today, and I'm going to draw it out on the screen too if you want to follow along with me, is I'm going to describe how different policy transactions affect your income statement, your personal income statement, and the same thing goes for your balance sheet. I'm going to describe how policy transactions affect your balance sheet. And if you understand how these things play in together, I think you'll understand the value that IBC is trying to pitch way in this 30-minute show. You'll be able to understand some things that maybe were lost on you for quite some time. So I believe that everybody who takes IBC and runs with it, whether they've thought about it with an income statement mindset or a balance sheet mindset, whether they've thought about that or not, I think it's truly because they understand what I'm about to go through. Everybody who is looking over the fence, who maybe has an infinite banking policy but just doesn't do much with it, and they're looking over at everyone else having fun at the pool party, and they're like, I don't know how to swim, I can't go over to their house, and I got to stand over here on my side of the fence, and you're looking at the party over there. It's oftentimes just simply because you have been misclassifying policy transactions, and you've been putting certain transactions on your income statement when they actually belong on your balance sheet. So that's really what we're going to do today. I'm gonna share my screen and build out some diagrams to really describe to you how infinite banking affects things and where the pitfalls are. So I'm gonna go ahead and do this. I've got my screen already shared. And so if you guys want to follow along on YouTube, that'd be fine too. But essentially, every person has an income statement and a balance sheet. Whether you're a business or an individual, you have an income statement and a balance sheet, just like Robert Kiyosaki talks about all the time. In fact, understanding an income statement and a balance sheet is very important. And here's the real key. The real key in all of this is understanding that your income statement personally and your balance sheet talk to each other. That's what happens. There's an accounting language that they're speaking to each other in, and how they impact each other is important for you to understand as you grow in wealth and grow in success. But on top of that, understanding how they talk to each other in the world of IBC transactions is extremely important. So let's go ahead and dive in. Everybody has an income statement and a balance sheet. Your income can be from many different sources. In other words, we're going to put down on the income, we're going to put down whether you have a W-2 income for working a job, whether you're getting a 1099 income and commissions, whether it's a K-1 income, which would be like small business ownership, or whether it's investment income. Essentially, these are the main sources of income that we're all going to receive in. We have our W-2 income, you could have 1099 income, you could have a K-1 income, which is business ownership income, or you could have investment income from whether it's real estate or whether it's policy cash value growth and dividends earning inside the policy. In other words, these are all forms of income that you could have from all sorts of different mechanisms. We also will have expenses on the income statement, of course. And so, by the way, what I'm going to do, and this is kind of based on, someone in a similar shoes to me, but then on top of that, this kind of goes back to the 4 stages of IBC webinar that I've done. I'm just kind of using the same numbers. I'm going to assume that this person has $500,000 of income coming from all of these sources, the W-2, the 1099, the K-1, the investment. $500,000 is coming in to their life. On the flip side, you'll subtract out expenses, of course, and that those were things. What I'm going to list out here is lifestyle expenses. Obviously, you'll have lifestyle expenses. You'll have taxes, are probably for almost everyone on this podcast. Your taxes are oftentimes your biggest expense. Charitable giving will be included in there, and I am going to include some items like car payments and mortgage payments as well. So car payments and mortgage payments can actually, you can make an argument that they could be balance sheet transactions, but for most of us, as Robert Kiyosaki said, they're taking money out of our pocket. We're going to call that an expense as well. So I'm going to assume that if I'm making $500,000 of income, I will probably end up having about $350,000 of expenses throughout the year. Now, some of you be like, that's a big number. Well, remember, anything that is an expense is taking money away from you forever. So if you're making $500,000 a year, you're probably going to write a check for $150,000 to Uncle Sam. Someone's got to feed the beast, right? And so that's $150,000 already gone. I'm a big giver as well. I tithe, and so I tithe on my gross income, by the way. So I'm going to give at least $50,000 to ministry. So that's already put together $200,000 of it. And then if my lifestyle is $150,000, then there you go. That's the $350,000 of expenses. So what ends up happening is you have your income, you have your expenses, and whatever is left is called your net profit. In this case, it is $150,000. We have been using a terminology for this called free cash flow in our previous episodes. Your free cash flow is essentially is this number. You have your income on top, you have all your expenses on bottom, and whatever is left, this is what's called your free cash flow. This is money that you get to do whatever it is you want to do. And in my case, it's going to be $500,000 of income, $350,000 of expenses. I have a free cash flow in my little hypothetical here of $150,000 that I have to do something with. And here's how income statements and balance sheets start to talk to each other. Anything that's left over on your personal income statement automatically moves to the balance sheet. That's essentially what's going to happen. So if I have $150,000 net free cash flow after I got income, expenses, whatever's left, it is going to move over to your balance sheet. That's the only number inside of your income statement that's going to start affecting your balance sheet. It's the net income. The free cash flow moves to the balance sheet, and I've got to do something with it. Okay, so maybe in our model, we would love to be paying a premium with this $150,000 and have it affect your balance sheet. So what I'm going to get into now, and what I'm going to premise this with, is that I believe almost every policy transaction is not actually an income statement transaction at all. They are almost always going to be balance sheet transactions. This is where people get really messed up, because you get really screwed up if you start putting policy premiums and policy loan repayments on your income statement if they don't belong there. Because the only place people put those transactions are in the expense category. And if you start doing that and you mistakenly move policy transactions onto your income statement, you will start to get weird. You're misclassifying the transactions, and it's going to mess people up. So it would be like saying, I'm going to take this $150,000 and buy a stock, but I'm not going to call it a balance sheet transaction. I'm going to call it an expense on my balance sheet. That's essentially what people are doing when they're paying premiums. They're going to mistakenly put something in as an expense, and rightfully so. I mean, we all have insurance premiums. Those are expenses in your lifestyle. You have car insurance premiums, you have home insurance premiums, you've got maybe disability insurance, you got long-term care. I mean, all these different types of insurance are all true expenses on an income statement. They live on the expense. They have no effect on your balance sheet. They're not balance sheet transactions. The one premium in the world that actually has an effect on your balance sheet is life insurance, whole life insurance premiums, or permanent life insurance premiums, of course. And so it's very unique. So you're capitalizing an asset, which we've been talking about many times before. So on the assets, by the way, you'll have policy cash value, you'll have real estate, you'll have stocks, mutual funds, or whatever it is that you like, retirement programs. All of these things are going to be on your asset side of your balance sheet. Your balance sheet is going to receive the $150,000 of free cash flow, and then from that point, it is going to decide where to put the $150,000 of free cash flow that it has received. It is going to move it into the various assets that you like to own. The movement between assets is not a part of the income and expenses that you have. On the flip side, on liability section for your personal life, you probably will have something like, real estate, you'll have mortgages on your properties. You may even have car loans. You may have a home loan as well. You may have investment debt, credit card, student debt, stuff like that. All that to say, of course, oftentimes we know what a liability is. But what I'm trying to bring up is to essentially illustrate why I think it's important to make sure that you're understanding the effect that policy transactions have on these various financial statements. Let's erase some of this and put down a real life example for how policy transactions are going to work in your premiums, loans, and loan repayments. So I have $150,000 of free cash flow. Let's go ahead and assume I've got some, policies like I do, and they're all, doing well. And I'm going to assume maybe I have $100,000 in my little instance of cash value sitting here on my balance sheet. If I have $100,000 of cash value and I just received $150,000 of free cash flow from my income statement, as we've always said, this money will normally hit a bank account and will be sitting in cash. This is actually the whole point of IBC, is that all of our free cash flow normally comes into a bank and then is dispersed, of course, around different transactions. And so I'm going to, of course, be a little bit simple here, but what I'm going to do is assume now that you have $150,000 of cash, you've got a policy already, it's got $100,000 of cash value, and you're saying, you know what? I want to move my $150,000 of cash into my policy. Remember, we are past the income statement. The premium that we're about to pay to move my cash into the policy to create cash value. This is now a balance sheet transaction. It is not an expense on my income statement. It's a balance sheet transaction. So I'm going to assume I've had the policy for a year or two, and we're just going to assume that I'm going to take my $150,000 of cash that I now have from my free cash flow in my life, and I'm going to use it to pay a premium in a policy that's a couple years old, and we're just going to assume that the policy now is growing by as much as we're putting in. So I write a check from my bank account for $150,000 to move it into the policy. And we're going to assume that my cash value is now no longer $100,000. Now we have $250,000 of cash value and $0 of cash. In this moment in time, have we changed anything about my balance sheet? Have I changed anything? And I haven't at this moment in time. I'm just moving money. And then we're going to assume that a real estate deal comes your way or something like that. And it's going to need $100,000 in order to take advantage of this real estate deal. So I am then going to take a policy loan from my cash value for $100,000 in order to go fund this real estate deal and a policy loan. Remember, I have $250,000 of cash value, and I'm going to borrow $100,000 against that cash value and go send it out to go fund this real estate deal. What is this net effect going to be on my balance sheet? Well, I still have $250,000 of cash value, right? But what else do I have? I now have a $100,000 new asset on my balance sheet. It's called real estate, don't I? So now I have a total of $350,000 of assets, $250,000 of cash value and $100,000 in real estate, and I have a $100,000 policy loan. As we sit right now, have I impacted my income statement at all still? No, I haven't yet. All I'm doing is moving money around because I still have a net worth of $250,000. I used to have $250,000 of cash value a moment ago. Now I have $250,000 cash value, $100,000 in equity in a real estate property, and $100,000 of policy loan. I'm literally just moving money around. But here's the key. Most of the time, people put their premiums as an expense on their budget. They're not treating it as a balance sheet transaction. They're treating it as an expense on the income statement. And so they really want to keep expenses low, don't you? Expenses take money away from you. You want to have lower expenses. So they always put less money in their system than they would otherwise like to, just simply because they've been misclassifying what that transaction is. The same thing, though, goes whenever you start getting weird with policy loans and policy loan repayments. So if we took out this $100,000 policy loan, a lot of people treat it as if it's a debt that they're used to, like a similar debt to all the things that they're used to receiving loans for. But we know that it's different. We know that loan repayments themselves are different whenever you own the note. So essentially, here's how it's going to work. We're going to assume that this $100,000 real estate investment is going to produce a profitable cash flow. And just to keep everything easy, we're going to assume that it's going to produce $10,000 of income inside of the real estate property. So if we have a real estate property that's now producing $10,000, we don't have $500,000 of income anymore. We have $510,000 of income. But our expenses are essentially the same. So if we have $510,000 of income and we have $350,000 of expenses, what does that mean our net income next year? What's that going to be? It's not going to be $150,000 anymore. It's going to be $160,000 now. So next year, you're going to have $160,000 move from your income statement to your balance sheet. Now we have another $160,000 of cash that's going to end up making impact on assets on the asset column. So if we say we're going to move $150,000 of this cash into policies, because that's where we want it to be, just like last year, we're gonna max out our premiums and put in as much as we possibly can. After this next year, you're gonna have $150,000 go into cash value. Once again, just to keep things simple, I'm going to not assume that the policy's growing with interest and dividends or anything like that. I'm just going to say we used to have $250,000 of cash value. Now we're going to have $400,000 of cash value. So that moved 150 of the 160,000 that we had. We still actually have $10,000 of cash left over. What should we do with this $10,000 of cash? Well, we have a couple of options. We could choose to pay back the policy loan as one of them. We could choose to start another policy with it if we wanted to, and just keep the policy loan over there on the liability section and not mess around with it. That's why it's so cool. But for our sake, we're going to assume we take this $10,000 of cash that the real estate investment is essentially producing, that's sitting here inside of our balance sheet as an asset right now in cash. And what we're going to do is we're going to write a check from that cash to pay down the policy loan. We're going to pay down the policy loan. So now that our loan balance is no longer $100,000, it's going to be $90,000 when we write this check. Now, some people are going to say, well, Nate, doesn't the policy loan have interest? Yes, it does. Remember, this is for simplicity. Does the cash value also earn interest? Yes, it does. I'm just not showing it in. Does the real estate increase in appreciation? Yes, it does. In other words, some people always want to get caught up in the nitpicky details. I'm just merely saying that these are balance sheet transactions fundamentally. And of course, I know that the cash value is growing with interest and dividends and the loan has interest to pay. But for our sake, we're going to write a check for $10,000 and we're going to hit the policy loan. So now we have $400,000 of cash value, $100,000 in equity in real estate, and $10,000 of cash. So that means we have a total of $510,000 in assets, and we had $100,000 in a policy loan. So $510,000 of assets, $100,000 in a policy loan means that my net worth is $410,000. The day that I choose to write this check for $10,000 to pay down the policy loan, how does that impact my income statement and my balance sheet? Well, first off, it doesn't impact your income statement at all. A policy loan repayment is not an income statement transaction. It is not an expense in your budget. It is simply going to be a movement of money. That's what it's going to be. So what's going to happen here is I'm going to write a $10,000 check out of my cash reservoir that's sitting over here on my balance sheet, and I'm going to pay down $10,000 of my policy loan balance. Let's make a quick accounting of where we're at. We have $400,000 of cash value, $100,000 of real estate, so $500,000 of assets, and $90,000 in a policy loan. What's my net worth? It's $410,000 net worth. I used to have $510,000 of assets and a $100,000 liability. Now I have $500,000 of assets and a $90,000 liability.
The conventional financial system makes the bank rich using your money and pays you next to nothing in return. At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to become your own bank. Visit livingwealth.com/bank on yourself. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even participants experienced with infinite banking often tell us how they learned a ton too. It's worthwhile regardless of your experience level. Stop letting the banks and Wall Street dictate your financial future. Again, that's livingwealth.com/bank on yourself to gain access to the free course today. Now back to Nate and Holly.
So what I'm trying to bring up is that the vast majority of policy transactions are simply balance sheet transactions. All we're talking about with policy transactions is where are we going to detail out the net income. In our minds, we want to pay premiums with that money, we want to pay loan repayments with that money, but none of those are actually income statement transactions. They are balance sheet transactions. We're just moving money around. Every time you repay a policy loan, you have no change in your financial position. In that moment in time, you've just moved money from one pocket to another. So instead of having $10,000 of cash and a $100,000 policy loan, I now have $0 in cash and a $90,000 in policy loan. What can I do the next day if I happen to need cash? I can just call the insurance company and have them send me a check for $10,000 to put the cash back in my bank account if I need to go spend it, and then I'm back to where I was. They're just simply balance sheet transactions. Both premiums and loan repayments and policy loans are always essentially balance sheet transactions. And it is the same for, even something like purchasing a car or something like that. If we're going to, borrow $50,000 out to purchase a car, once again, the payment is going to look and feel differently when you're in the banking seat as opposed to just simply the borrower's seat from somebody else's bank. We suggest, by the way, that you have a car payment built into your lifestyle expenses. You are going to be driving, you're going to be driving for quite some time. The cars will wear out and you'll need to replace them. So you should have in your lifestyle expense concept the idea that I need to buy a car at some point. So it is true that you could choose to borrow money from a bank to purchase a vehicle, or you could choose to borrow money from your policy to purchase a vehicle, and the payment that you make back, I think in that instance, it's perfectly normal to add that in as a lifestyle member of the lifestyle. But here's actually how it's going to impact the balance sheet as well. If we were to pull out $50,000 to purchase a vehicle and then pay it back, at let's say like a 10 grand throughout the course of the year, once again, you actually will start to see that your income statement and balance sheet are talking to each other, especially in this way. But what I wanted to mention is that it really doesn't matter. You could choose to add $50,000 of a liability to purchase a car from a bank, or you could borrow from your cash value to do it. Either way, there's not going to be much of an effect on your balance sheet, because if you borrowed money from your policy, let's say we had $400,000 of cash value. We now have a $400,000 cash value with a $50,000 liability, and we're using some of our lifestyle money to pay back that liability because it's a car, it's part of our lifestyle, it's an expense that we're going to have to carry forward with us. The same thing could be true, though, if you had $400,000 of cash value and decided to borrow money from somebody else's bank to purchase the car. You still have $400,000 of cash value and a $50,000 liability, and you're paying down the liability with your $1,000 a month. Which is one of the reasons why I've told people that there's no magic in using IBC. So there is, of course, value to using your own policy to finance things, but you should be aware that it's okay to use, let's say, a bank money to purchase a car if you want to, if it means that it allows you to not use up any of your collateral ability inside of your cash value. In other words, if you wanted to borrow 50 grand from a bank to purchase a car, even though like I would like to own the note myself. I would like to repay on my own terms and my own schedule and have total flexibility and freedom that IBC can offer. But I actually think I might need that 50 grand to go do something else. Maybe you're running a business and you're looking to expand. Maybe you're looking for investment opportunities, and you say, well, you know what? Actually, I do think I want to set aside that money in my cash value to go do something else. So I'll go ahead and borrow from the bank, and that's perfectly fine. But nonetheless, what I'm saying is when you take a policy loan out, you're moving money. Whenever you're making loan repayments, you're moving money. And whenever you're paying premiums, you're moving money. But none of those things are occurring in the expenses of your life. Or in other words, the policy transactions are not meant to create new expenses in your life. It is true that you can borrow money from your policy to pay for things inside of your lifestyle, and then take the money that you normally would have paid just directly as part of your lifestyle to repay a policy loan. But I hope you can see in that instance, once again, we're not changing your lifestyle expenses at all. And so the repayments of the loan, while they might be included as part of your lifestyle expenses, they were always included. So we've talked about this for like a vacation. Some people would say, well, Nate, if I borrow money from my policy to go on a vacation, I have to pay that loan back. But if I just pay cash for it, I don't have to pay anything back. I'm like, well, that implies that you never want to go on a vacation ever again. Vacations cost money, right? So if you choose to pay cash for a vacation, you're going to have to repay your vacation. You're going to have to move money into your bank account in order to pay for the next vacation. So if you chose to pay the 10 grand vacation from your policy, then it would make sense to pay back over time that loan to be able to do it again, but you'll be doing that anyway. That's part of your lifestyle. That's part of the expenses that are already built into your income statement. Is the cost of going on a vacation is already built into the lifestyle. So you can either choose to build up that expense in a bank account and then pay for it, or you could choose to pay for it from a policy and build back up the policy by making policy loan repayments to pay for it. So it is true that I understand some loan repayments could be designated as expenses. The point of the matter is, anytime we're using policies to do lifestyle things, then the repayments will use lifestyle money, but it would have been money that's already being spent. So with all of this, I hope it's been helpful. I don't even know if I've hit it as clearly as I wanted to, but essentially what I'm trying to get at is that as you're practicing IBC and you have this ever compounding pool of cash value growing for you at all times, as you're borrowing and repaying and borrowing and repaying, you're just essentially creating wealth due to the uninterrupted compound interest that's occurring inside the cash value. But you will get way off base if you start to include in your expenses of your budget policy premiums and policy loan repayments. And if you put the policy loans that you're taking out of the policy and classifying them the same way as like a credit card debt or something weird where you don't have any, where in other words, it doesn't impact the balance sheet at all, and you're forgetting how it's impacting the balance sheet. And so all you see is, I got to make this new policy loan repayment. You start to get in this weird, awkward situation where you're due to misclassifying things, you will stay frozen in space. You won't make policy transactions if you are confused as to what they're doing in your overall financial life. So if you're confused at what policy transactions are doing, you will sit here scared to do any policy transactions. So you'll pay low premiums because you think they're an expense and you like to keep expenses low, so you'll pay low premiums. You won't borrow money because that's adding a liability, and you don't like liabilities. And so I'm not gonna borrow money. And then if I borrow money from the policy, I gotta make policy loans. That's more expenses for me. But all of that is incorrect. It's not even just Nate's opinion. It's just simply, you have to understand how financial statements work. A policy loan is a transfer of money. A policy loan premium is a transfer of money. A premium is a transfer of money. All of those are assuming that money is moving from the income statement to the balance sheet anyway. If your income and expenses are the same thing and there's no money moving from the income statement to the balance sheet because you don't have any free cash flow, then you shouldn't do IBC. It's not going to help you. IBC is discussing how to manage the free cash flow in your life. I hope this has been helpful. Well, once again, if you would like to have followed along, you can view this again on YouTube where I've got some diagrams here. I've had fun doing it. I'm going to revisit this with a pure YouTube video later on. So we'll announce that later on, where I'll do a similar setup, but then I'm actually going to pull up real policy illustrations and show with real numbers how those transactions are playing out. So just be aware of that. I'm going to post that to YouTube probably in the next couple of weeks as we speak. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before we go. Start your journey towards financial security and wealth today. Visit livingwealth.com/bank on yourself. Upon completing the course, you'll have all the information you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/bank on yourself.